Hello and welcome to the Crypto Insider interview. I'm
Oh,
Vlad, and today my guest is Miko Matsumura, who is one of the co-founders of Evercoin, which is an exchange, a wallet, and also a really nice interface for crypto. And he also advised many token projects and ICOs, and welcome.
thank you very much.
So, could you please tell me more about what your involvement is in this business?
Yes, so I'm a co-founder of, as you mentioned, an exchange and wallet called Evercoin, and we really are pioneering the non-custodial space. So, if you need a wallet, we're definitely a multi-coin, a strong multi-coin wallet. We do provide custody, so everyone has their own private key, and pretty much we also allow for mobile exchange. So the idea would be, if you're looking for that combination of mobile wallet exchange, that's Evercoin. In addition to that, I'm also an investor in the space. So I'm a general partner with Gumi Cryptos, which is a $30 million investment fund based in Japan. So we invest worldwide, and we have partners in the San Francisco area. That's pretty much where I live.
Okay, so I'm going to take these one at a time. You mentioned that in Evercoin you get to exchange different cryptocurrencies. And how does that work? Do you use a third-party service like Shapeshift, or do you have your own, how do you call it? Like, do you store your own coins which you exchange, or do you use a third party for this service?
Yeah, I can explain pretty easily how it works, which is we built our own exchange backend. So we really are the only provider that has basically a full stack. I think from our perspective, there's two big differences when you have the full stack, which is both the exchange and the wallet integrated. One of them is a better support experience. So, what can happen is that you can have a wallet provider and an exchange provider that doesn't really interact or connect well. And then you can have a potentially a complicated support experience. Another thing that I think is important about having the full stack is uh, really that we're able to create some really neat optimizations. For example, we have this wallet-based limit order. So, it's easy to create a limit order if you get custody. So an exchange can create a limit order because what's happening on the back end is you've already sent all your money to the exchange. So they can tell you anything and they can make anything happen because it's not actually happening on a blockchain. It's just happening inside a database, And so in a wallet, it's actually hard to do a lot of things technically. But if you integrate the wallet and the exchange component, you can actually do some very novel and exciting things. So, we really are, I think, a unique service. And, I think for people that do want custody of their own cryptographic assets, it's a very, I think it's a great solution, particularly if you're interested in having a mobile wallet. We find that our customers tend to be a pretty dynamic group of people. And so, they have busy lives, they're traveling or they're going places, they're in meetings. And, if they want to make a trade based on things they've heard, the mobile component makes a big difference to them. So you're able to maintain a bunch of coins together and you're able to basically do change based on, news that you hear or things that you need to do.
Okay. I've asked that question specifically because I know there are multi-coin wallets such as Exodus and I think Jax, which also integrate functions to exchange your coins into something else. But
Sure.
that's done through a third party, and I wanted to know what's so novel and unique about Evercoin, and I guess you explained it really well.
Well, thanks very much. And we like those guys. Particularly we like the Exodus guys because we know them pretty well. We don't know the Jax guys as well. I think one of the things that's important in multi-coin as well is the mobile aspect. So, I do think that that's a distinction, and I think it's something that our users value quite a bit. So I think to me, if you're in the mood of kind of being glued to trading, and you're trading for like 5 hours a day, or if you're a professional, that's really more typically a custodial use case. So, if you, that's sort of a Binance use case if you're a day trader and that's your job. But if you're not a day trader and that's not your job, and I think people really got excited by crypto and they started doing that, for hours and hours. But, if you're more like me and you actually have, other things going on other than trading, you do want to have custody, because you're a crypto type of person. But at the same time, you don't want to end up being stuck, right? So you don't want to end up being in a situation where, you find out you have to do something, and you can't wait to get back home, and then you have to transfer from your wallet to an exchange in order to make the trade. By the time you've done all that, probably the news cycle has passed, and whatever happened already happened. So to me, the limit order allows you to kind of do that more dynamically, as well as the mobile aspect allows you to do it on demand. But the point being that, of course, you could set a limit order on something like Binance, but then you don't have the private keys. So, for it's a certain combination of user that really, really wants this combination of features. So, I think it's not, we are building a desktop interface that will serve a larger group of people, but I think, for now, our service is really for people that understand, why they want to have the keys, and, people who want the mobile multi-coin experience. But, I think for those users, I think we really have a sweet spot.
I think that's one of the big issues with Robinhood, which is a service which received a lot of attention for having zero fees right in the middle of the bull run of 2017. It was a big issue at the time to buy Bitcoin because you could get these huge fees, and they just came around and said, we have zero fees. But at the same time, they did not allow you to have your own private keys. So that's not always the kind of trade-off that you want to have.
Yeah, I mean, from our perspective, there are a lot of major services, Coinbase and Robinhood and these types of services that don't give you your keys, and there are certain customers for whom that's acceptable. But I think it just really depends on kind of who you are, and if you're really kind of in the crypto business. I think for people who are a bit more novice, then the question becomes kind of, who do you trust? And I think that's something that I think people have to make their own decisions.
Now, tell me more about your fund and all the companies and projects that you got involved in.
Sure. So my fund is called Gumi Cryptos, and it's a 30 million USD fund. One of the nice things about Gumi Cryptos is that they say it's, in some ways, it's better to be lucky than good. The thing that's been nice about Gumi Cryptos is that we have had good, relatively beneficial timing, and so we're a USD denominated fund instead of an Ether denominated fund. So luckily for us, we haven't been negatively affected as much by the crypto crash. We did make, I would call them judicious, investments during, more of the time of increase. One of the examples of one of our investments was recently hit the news, which was Basis or Basecoin. So we did make an investment in that, alongside a lot of pretty prominent investors. Obviously, them, Andreessen Horowitz and others. And recently they made the news because they're returning all the money. So that's a pretty interesting thing, and it's in some ways the benefit of investing in really great deals with great founders. We do have a number of other investments in the space. If you go to gumi-cryptos.com, you can see our portfolio. But we're not. We still have quite a lot of dry powder, and in a way, one of the things that we have as a fund thesis is that there's going to be a bottom to this crypto market, and we're going to see the crypto market recover. So to us, we're not day traders, so we don't predict the timing of this. But from our perspective, if we continue to professionally allocate capital, using essentially a venture capital type of a model, we should end up seeing venture class returns. So that's the fund thesis. So we continue to have dry powder. We continue to make judicious investments, and our average check sizes are $250K to about $1 million. So, if you look at a $30 million fund from that perspective, you'll probably get, 50 plus portfolio companies over time.
Yeah, but that's still impressive. And I was about to ask you, how do you find, or are there any differences between the way you conduct business and cryptocurrencies in the United States and in Japan?
Yeah, so, obviously one of the major issues in the US domicile is the regulatory force. So, one of the things that recently came out is, when you look at the news around something like a base coin, one of the things that they declared is that they didn't have a regulatory path forward, right? So if you look at the designation of their product as a security, then there are restrictions and limitations to how they can distribute and sell that security, and their conclusion was, our original plans are not really going to work, and that's why they returned investor capital, which I thought was the right thing to do. From my perspective in the US, the SEC has been quite clear, which is that, if you're really looking at something from the perspective of investment, and if you're looking at investing in something that needs to be built by the money that's being invested, then you're really talking about a security. And at that point, the logic becomes, you should consider equity investment, because that's something that's much more traditional and, it's well-paved path. So, I do think the US perspective is, we have to be sensitive to the regulatory conditions here. Obviously the same in Japan, but we tend not to make that many investments in Japan. One of the things that we do as a fund is we bring companies to Japan, and we benefit them by our strategic relationships in Japan. And so because of that, companies that are already in Japan, we don't really need to help. They're already successfully in Japan. So I think from our perspective, we do like to invest in the US as well as, more broadly overseas. But at the same time, we do recognize that the US jurisdiction has some interesting regulatory issues.
Oh, yes. And also, I was really impressed when I realized that there's a lot going on in Japan and in South Korea in terms of the market. And at some point last year, I read that 1 in 3 office employees in South Korea were actually trading cryptocurrencies or holding some kind of assets. And that to me was very impressive, just knowing that you have this very broad and enthusiastic embracement of cryptocurrencies.
Yes, Korea is definitely the penetration among white collar, it's very high. Japan, probably a little less, but one of the things that's notable in Japan is the participation of institutional investors. So if you go to coinhills.com, you can see the BTC to fiat exchange on a daily basis. And you'll see exchanges like BitFlyer, which has very, very big exchange volume in Japanese yen. And so, over the past 6 months, we've seen the daily exchange volume fiat to BTC. Japanese yen has been between maybe 40% of total volume and it's been as high as like 75% of total volume planet-wide. And so, it's moved from, I think the US is now in the lead, but I do think that Japanese institutional investment has been pretty strong. And Japan actually, oddly enough, was the first country to declare Bitcoin as legal, which is interestingly enough, I mean, most countries recognize it, but Japan, I think, was early to recognize it as a legal property. And so it's interesting to see Japan's role in the crypto economy, given that it is by some measures the third largest national economy in the world.
And also, I guess that's the reason why Mt. Gox, the now defunct big cryptocurrency exchange, and also Roger Ver, he operates his business from Tokyo.
Yeah, absolutely. I'm friends with Roger, and we'll be chatting this week about all the Evercoin, and we'll be talking about some other things as well. But Japan is definitely a unique location for the cryptocurrency movement. One of the things that happened, I think you mentioned Mt. Gox. The other one that was difficult for Japan and Japanese regulators was CoinCheck, which was about $500 million USD worth of NEM that was hacked. And so, I think that Japan has been hosts to some spectacular exchange hacks, and that's obviously a pretty bad thing. And it's really affected the regulations, it's affected the climate, it's affected the mood a lot in Japan. But the good news is that the JFSA, which is the financial regulator in Japan, has transferred regulatory authority to an SRO, or self-regulatory organization, effectively a group of exchanges that are now licensed by JFSA. So what's happened in Japan is that we've seen kind of initially like a freezing up of the regulations under the authority, and then now it's probably in a trend line to move towards opening and liberalization. And I do think that it will take time, but one of the things that happened with the JFSA in Japan, the regulator, is that they realized that I'm going to maybe exaggerate the percentages because I don't know the absolute numbers, but it probably seemed to them that half of the people in Japan were yelling at them to go faster, and then half the people were yelling at them to go slower. And so I feel like the pressure in Japan from the regulator, also in Korea, by the way, the pressure to the regulators is immense. And if half the people are yelling to go faster and half are yelling to go slower, you just feel bad. Like, you just feel a lot of pressure, and obviously when there are failures like exchange hacks, then, obviously people become even more, extreme, and they become even more angry. And so, I think what eventually happened in Japan is that the Japanese regulator realized that they didn't actually have the knowledge about the industry to move quickly, and safely, right? So you have to move quickly, but you also have to move safely. And so for them, their strategy was to move to a self-regulatory organization. And by the way, like, industry self-regulation is not unprecedented. If you look at in the United States, for example, if you want to get the so-called broker-dealer license or ATS license or alternative trading system license, that's all granted by a self-regulatory organization called FINRA. So like, the US has its own self-regulatory financial bodies. And so, it's not unprecedented or strange, because ultimately you have to regulate the industry using intelligence that can come only from the industry. I mean, in a way, this is why we got in big trouble with Lehman Brothers and with big banks, right? Because, in the history of our global financial system, it turns out that in order to regulate banks, you need to know a lot about banks. And so, there's effectively what's called a revolving door, where people who work at banks become lobbyists, and the lobbyists basically lobby Congress and so they just move between banks and regulators, and that's kind of what caused banks to become too big to fail. And, again, if you actually flip over into the crypto space, we now have exchanges that are too big to fail. And I think that's another potentially scary fact.
Which exchanges do you think are too big to fail? Uh,
Okay, you're
did
back.
you get that?
No, I didn't.
It told me that my internet connection is unstable. So, which exchanges do you think are too big to fail?
Well, I mean, I think if you go to something like CoinMarketCap and you look at the top 3 or top 5 exchanges, I think they've definitely reached a point of too big to fail, and that's a little scary style of exchange is that, the way I look at it is, Bitcoin has been pressure tested, and it's been pressure tested up to like a couple hundred billion USD. And one of the reasons why it's able to survive such a pressure test is really, if you reason about it, it's partly due to decentralization. Now, I know that sounds a little bit like kind of crypto mysticism or hype, but I'll give you a really simple example, right? Which is what people don't understand about kind of pressure tests is that each level of pressure test is actually a different test. So for example, $100 billion is a different test than $200 billion, which is a different test than $300 billion. People generally think, it's just numbers. But the thing that happens is that different kinds of attacks become economically feasible at different levels of pressure, right? So if you have a pile of money, the bigger the pile gets, the more complex and economically challenging attacks become feasible. So for example, state actors could potentially attack something like a Binance, right? So let's say for some weird reason, let's say that the keys are controlled by CZ from Binance, right?
Mm-hmm.
So the thing that's really interesting is that centralization, right? It means that if you have a state actor who decides to kidnap him, or God forbid, I mean, or you could even have tanks. The thing that's really the example I like to use is, if you get enough $1 billion involved, it becomes feasible to use tanks to attack a building, which is a very strange idea. But the thing that's interesting about Bitcoin is you can't actually attack Bitcoin with tanks. Like in some level, it doesn't matter how many tanks you have. Like you can't get all the Bitcoin, Now, obviously, if we as an industry pile all the Bitcoin into a single address, then you could probably use tanks, right? And so not to be like ultra libertarian or weird or anything like that. I'm really just talking about the pragmatic reality of holding custody over assets, right? Which is the pragmatic reality is that the bigger the pile is, the more vulnerable it is to attacks of centralization. I mean, the same thing is true of data. So if you look at the 500 million user accounts that were compromised by Marriott hotels, apparently Chinese hackers attacked that. The fact that you have all of that stored in one giant pile makes it, it makes it very vulnerable, and it makes it very attractive, right? So, having giant piles of things is probably an anti-pattern for security.
Yeah, I guess that's called the honeypot issue. When
Yeah.
you just have the honeypot and you attract attackers, they just have the financial incentive to actually try.
Yeah, and the bigger it gets, the more outlandish the attacks can become, right? So there are definitely like crazy styles of attacks that become economically feasible after a certain point. So each new size of pile produces new kinds of attacks that were previously unfeasible. So the way I look at it is the kind of notion of a centralized exchange. One of the things that's crazy about, so if you look at the fiat banking system, I think about 8% of it is actually cash. and then the rest is electronic, right? So the thing that's amazing about centralized digital money, which is what the fiat banking system uses, what's interesting about it is you can actually pretty easily reverse things, right? So if you electronically, it's really hard to electronically steal $1 billion from a fiat bank. Like, it's just hard to do, right? Because what do you have? Like, it's like, oh, I got access to the cryptographic keys of the bank and I transferred $1 billion into what? Into a bank account that I have at that bank. I mean,
Right.
it's right.
That's insane.
Yeah, like that's not what you do, right? And so since so if you transfer it from the bank to your bank account at that bank, they're just going to, they're going to do what Vitalik did with the Ethereum Classic, which is, they're just going to reverse immutability and flip it back and be like, wow, and then they're going to put you in jail, right? But the point being that in cryptographic assets, it's very different, right? Cryptographic assets, when you have custody, if you transfer them to your wallet, like, it's kind of over, right? Like, you did it, like you're free and clear, which,
Hmm.
obviously you may have to do some weird things like, laundering or, stuff like that. But like, aside from doing stuff like that, you're probably scot-free, which is unprecedented, right? In some ways, I think that's something that the industry has tested, and and it's proven to be true, right? What's proven to be true is that at some point a centralized exchange will pop, and I feel like that they're just like balloons. Like, each balloon, you can have really, really big balloons. You can have balloons that are so big that you can sit in a basket and float around underneath them, right? So, but at some point, every balloon has a point where they can't handle the pressure, and so I think that's something that we learned as an industry. Not all the exchanges have popped, but they all should at some level, right? Like, there's some maximum level at which even these really well-run exchanges can be compromised.
Yeah, and the issue with centralization of crypto exchanges is that sometimes you're not allowed to withdraw all the coins that you want. And I have a friend who told me that he had like 10 Bitcoin and he couldn't withdraw them without providing a lot of documents. And even after that, after fulfilling the KYC requirements, they only allowed him to withdraw like 2 every week. And
Yes,
it was also
absolutely.
delayed.
Yeah, and the thing about withdrawal limits and withdrawal fees and all of the friction, like, it makes sense and in a way, when you look at that, it's some level even a protective measure, right? In the sense that, like, what it suggests is it suggests that the exchanges actually don't have the liquidity, right? And
Mhm.
what I mean by that is they're protecting themselves, in the sense that if every single customer said, I'd like all of my money now, right? Like, it suggests that they wouldn't be able to deliver it, right? I mean, like a bank, most of these organizations are doing things with the money that's in the accounts, and we're not sure what they're doing, but since it kind of went off chain, like, we don't know what they're doing. But the point being that, the liquidity may not be there. And so, obviously they have to protect themselves by creating exchange withdrawal limits and withdrawal fees. So, it's definitely something that people should be conscious of, and that's really why philosophically we built Evercoin. I want to provide, it's funny because people are like, oh, well, you can do limit orders, but can't you just do that on a centralized exchange? And of course you can, right? But from our perspective, we'd like to be able to rebuild all of the services and all of the user experience, and even like most of the speed of it running in a centralized format, but also doing it in a decentralized and non-custodial way. So owning your own keys. So that's very important.
It makes sense to remind people all the time that unless they own the keys, they do not own the coins.
Yes, that's absolutely fundamental. And, it's interesting because it's the part of this phenomenon that is really fundamentally new, right? That's the new part, right? Which is at the end of the day, you can create simulations and you can create everything that the old system used to have. But if you read the second sentence in Satoshi Nakamoto's Bitcoin abstract, it really says that, like, most of the benefits are lost if you require a trusted intermediary. It's like a bank or government or something like that. Right now, again, not to be like overly crypto anarchistic or libertarian, but, like, if you're doing the crypto thing, you should get the benefits at the very least. Otherwise, why do it?
Yeah, it's the same issue which I read from Tim May. He gave an interview 2 months ago for CoinDesk, and as you know, he passed about a couple of days ago. And he said that the biggest issue that he sees with Bitcoin is that it's transforming more and more into just another banking system and something which resembles PayPal because of regulations and because of exchanges and because of all the KYC. And at the end of the day, it will not make much sense if we over-regulate it.
Yeah, I think so, because the thing to me is that we really need, I'm not definitely not a anarchist or even a libertarian, but to me, on September 15th, 2008, the collapse of Lehman Brothers demonstrated fragility in, people think, oh, banks are so big, how could they be fragile, right? But that's actually not the right mindset, right? The mindset is it's monocultural, and so, it's like having a single crop. If you have a very large crop, then, like, of all the same species, then one single disease can wipe out all the crops, right? And so it's the same kind of fragility, right? And so, to me, I've never been one for even disrupting the world financial system. It's more about improvement. And, a major improvement is to increase decentralization in order to prevent, the kinds of economic collapse that we saw in 2008. And if you realize, the Bitcoin white paper was published a month after the collapse of Lehman Brothers. So, it's certainly not a coincidence. I don't think Satoshi Nakamoto published it by coincidence in the time, nor do I think it was a coincidence that it started getting attention, because people realized that, wow, these banks that are too big to fail, the net economic impact of them failing is pretty catastrophic. And the measures taken to prevent domino failure of all the banks was actually pretty catastrophic. So, the things that happened with quantitative easing were very, very extreme. And if you actually go back and look at the history, the things that were done to save the rest of the banks were extreme. Those were extreme measures. And, hopefully we'll never have to do that again. But I don't think we're headed there at the moment. I think we have a lot of work to do.
I don't think we have learned the lessons from giving too much power to banks and turning them into an extension of the state itself. I
Yeah.
remember when I was in France and I had a scholarship there, I basically had no rights and could not rent anything, could not get a student bus ticket, couldn't get a phone number without a bank account. And basically, if I could not go to a bank and negotiate with somebody and tell them, I'm not a citizen, I'm going to be here for 6 months during my scholarship, I just need this account to be able to make payments. And I got rejected a few times. So
Yeah.
that's insane. We entrust banks way too much with our daily affairs, and even the government does it. Okay, so as I was saying, a state like France, which is one of the biggest world powers, trusts banks way too much. And there is nothing that you can do as a citizen in terms of economic freedom unless you start a bank account.
Yeah, I mean, my perspective is this, right? Which is that we're all in this giant experiment and we're all trying to do our best, right? So, at some point, like, we as a society, we want bigger and stronger infrastructure, right? And if you want to do things like build cities, and these types of things requires financial infrastructure, and the financial infrastructure needs to be like really, really strong, right? So the question becomes, how do you get financial infrastructure to be strong? You know, at at the time, the best technology that we had was centralization. And centralization, isn't like, again, I'm not kind of such a radical as to say that centralization is a bad thing. It's actually, the vast majority of the benefits we've gotten from information technology so far have been through centralization, right? Which is things like the database, right? Databases are amazing. And to some extent, if you look at centralization, centralization is even a relative term. So what I mean is that, if you look at most databases, yes, they're centralized from the perspective of control, but they're decentralized from the perspective of, essentially distributed computing, right? So if you look at, common open source databases like Postgres or MySQL, they're usually run in like, a cloud form, and they're usually run in a highly replicated form. So, the thing that happened with the Bitcoin white paper was that we created something where the control was effectively decentralized through proof of work, and that was kind of new technology. And now I think we have the opportunity to explore how that new technology can be, used to improve, the existing financial system. Responding to your original comment of, there's too much dependency on, banks. I would say that, certainly the collapse of Lehman indicated that there is deep and fundamental fragility, especially when you look at the issue of how banks are regulated, which is effectively regulate someone who's that powerful. And, they can go off the rails as a function of not being well regulated. And that's in a way, we have to assume that as an emergent property of the system we created. So, I like to say that we reached a period in history that I call peak centralization, which is that we really squeezed as much as we could out of centralized social networks, centralized technology providers, centralized banking institutions. Even government centralization is being shown for, it has weaknesses. It's been a tremendous run, but centralization give way to something more sophisticated.
I guess I agree with you, and I'm a political science graduate, and all my academic life, I've learned that it's good to trust the government, and that's all this world is about. But at the time, I didn't know about forming small communities, how you can self-govern, how you can decentralize power. And I've actually noticed that in places where the government isn't as prominent and as powerful, the people who live there in communities are much more incentivized to work together and get stuff done. And it gives them a greater sense of belonging there. Whereas when you're in the middle of a big city where you have a lot of centralization, you notice that somebody threw maybe a banana peel in the middle of the street, and you don't care that somebody might slide on it. You don't pick it up. You're like, that's not my problem. That's the same with homeless people. You see them on the streets and you say, actually pay taxes. They have their own shelters. So if they're still here, then it's not my problem. But if we didn't have as much centralization and we were much more free in this regard, I guess we would care much more about what happens in our neighborhoods, in our cities, in our countries, and so on.
Yeah, I think what you're describing is the design of incentives, right? And I think you're describing kind of scalability issues, right? Because as you try to scale everything, you really end up with some complicated issues, And so I like I was saying about, something more sophisticated. I think when I say something more sophisticated, I'm not naive enough to think that decentralization is, quote unquote, the solution. I don't think decentralization is the solution, but in a way, one of the things that's been incredible about the experiment of Bitcoin is that, it has created a true alternative system, which is that it is probably the first financial technology that provides for, a digital asset that doesn't require a third party trusted intermediary, right? So it truly is kind of internet money. And so, I think that's an amazing thing. Obviously, I'm not, when I say Bitcoin is an experiment, I'm not being pejorative, because, just a few minutes ago, I said that banking was an experiment, and, governments, democracy is an experiment. So, I'm using the term very, very loosely, because, we're trying these things. And, I sincerely believe that we are all trying to do the best we can, but we have to learn. And I think one of the things you hit on the nail, or they hit the nail on the head, is that, I don't think as a society we've learned the lessons from Lehman Brothers, and I don't think we've learned the lessons about over centralization, and I feel like we're going to keep getting whacked until we figure these things out.
Yeah, I agree. But now let's get back to talking about Evercoin, because I took a look at the cryptocurrency projects which you support. And I noticed that you have Bitcoin Cash, but not the two versions of the fork. As in, you're not describing that there are two of them. And I wanted to ask whether or not you acknowledge the ABC version, which Roger Ver supports, as being the Bitcoin Cash. And also you have Dogecoin, which is an interesting choice of listing. Do you think Dogecoin has any value?
Yeah, I'll take those two questions in two parts, right? So I think we're following quite a lot of industry standards, right? Which is that we're using the Bitcoin Cash, because effectively what happened is that the Bitcoin Cash effectively was performing an update, right, which is a hard fork update, right? So when you look at the emergence of a new coin like SV, from our perspective, what our responsibility is we will, after the network has kind of stabilized, obviously there's no replay protection, so it's complicated to manage, but we definitely want to provide a mechanism for our users to essentially get both sides of that fork, right? That's in some ways having the key itself is really, in some ways, a pledge from the technology provider to be supportive, right? So from our perspective, whether we create a wallet that contains the SV and then gives the user what they're due on chain, or if we create some kind of a transfer tool that allows them to send it outside of our system to a wallet that accepts it, we're certainly open to that, bound by our own kind of technology resources and our ability to execute that, right? So we're working on solutions for that. From a political perspective, as an exchange, we don't take sides, and we definitely want to be supportive of this kind of decentralized model of governance that Satoshi espoused from the beginning. So we're definitely working on being neutral here, but I think the prime directive for us is to support our customers the best we can. So I think that's the philosophy we take there. With respect to Dogecoin, which is, I think, obviously, I know Jackson Palmer, the founder. He's not really all that involved in it anymore. So the question becomes, what is the value of a Dogecoin? from our perspective, if you look at it from a technology-based perspective, it's a fairly easy coin to support technically, being a Bitcoin variant. And so from our perspective, we're not judgmental about it. It's really just something that we thought would be pretty easy to put in. And, people do seem to like it for whatever reason. So, it sort of earned a place in the pantheon of coins. So I think that's really the way I would look at it.
Also, I've asked you the question because I wrote an article last week, and it was based on the website which Jackson Palmer has also created, which is called aredecentralized.com. And he basically presented that Dogecoin, I mean, that's not the conclusion that you see, you just see some data. But I wrote the article to present that Dogecoin has actually many more nodes and is more decentralized in terms of ownership than projects like Stellar, like NEM, like XRP. And I think there were two more, Nano, and wait, also IOTA. And Neo is very centralized. And to me, it was surprising because these projects take themselves much more seriously and they promote themselves as being decentralized, with the exception of NEM, which wasn't as decentralized from the very beginning. But, we should be concerned if we want to see a next bull run in which people trust these assets and invest their money in them. We should make sure that they have more nodes, that the distribution of the coins is fairer, and it's not just top 100 wallets holding most of the assets, like 70% plus.
Well, I think your observations are valid and helpful. I think, but they also point to something that's a little complex about this concept of decentralization, right? Which is that it isn't a monolith sense that you describe two dimensions of it. One of the dimensions you describe is nodes, right? So you said, oh, well, how centralized are they from a node perspective, right? Because, if you look at something like an EOS, it's like 21 block producers. My understanding is Neo has quite a lot of centralization in terms of the number of nodes or block producers, and a lot of these sort of so-called performance chains are reliant on for their performance, and that makes sense. But the other thing that you talked about was, wallets, which is you talked about ownership, and you talked about, so that's another dimension. And those two dimensions are very separate, right? So you can have something where every single wallet only contains one coin, and so you have a very decentralized ownership, but it may be running in a centralized database. So the point being that, like, there's a nuanced conversation to be had. I do think that everyone should be aware of these different issues. And I think, Jackson Palmer has been incredibly educational and informative. He's got great YouTube videos. So I encourage people to follow him and, study his content. Obviously, Andreas Antonopoulos, there's a lot of educational resources people should dip into that will help them understand what they're getting into. To me, I think with respect to trust, one of the bigger issues about the trust that will hopefully backstop a new kind of rise or bull run in the space is really ultimately more people delivering more value, and really when you talk about more value, it's really kind of delivering on promises made. So I think one of the biggest issues has been too many promises, too little delivery, and in a way, I think the promises were proportional to where we've reached, which is that, the maturity of market adoption and the maturity of the technology, hasn't been sufficient to meet all of the promises that were being made. And so I think, in a way that's caused the space, a lot of undue suffering. But, I think from the perspective of, making and keeping promises, part of what you're pointing out is that, we should all scrutinize each of these, infrastructure chains and try to understand what we're getting.
Yeah. I know that Neo, for example, promises to be a much more capable network to provide the infrastructure for dApps. But if you think about it, if the network itself is so centralized in terms of infrastructure and the tokens are centralized in the hands of a few, it's much more vulnerable than Ethereum, which maybe not, it's not as scalable at this point, but it's much more secure to host an application on it.
Yeah, I think that that's really the trade-off, and the question becomes kind of what people are willing to accept, right? And you know, I will kind of lean into the word I used earlier, which is experiment. You know, and in a way, I find that I'm less kind of moralistic about centralization than a lot of folks in the industry. From my perspective, a lot of it has to do with system design, you know, which is, it depends on what you're trying to do. But I guess the thing that frustrates me sometimes about some of these infrastructure chains is that they are some ways pulling an intellectual fast one on the people, right? In the sense that it's intellectually dishonest to deliver performance simply by moving the slider of centralization. You know, I have a thought experiment coin that I call Oracle Database Coin, which is, you know, moving the slider of trust from 0 nodes. So Bitcoin is trust 0 nodes, right? And I can move that slider to trust 1 node, and I can deliver you 1,000,000 TPS, right? So, you know, and I can do it by just setting up a single Oracle database, you know, and having everyone trust me. And if everyone trusts me to run the Oracle database, then I can give you 1,000,000 TPS. And that's really fast. Like, you know, from a, you know, and I can even chain the blocks if you want. Like all the transactions that come into my Oracle database, I can put a stored procedure that actually chains the blocks together cryptographically. You know, I can give you immutability. I can give you all the properties you want except decentralization. And I can give you 1,000,000 TPS. The reason why I'm less moralistic about these approaches is that some applications require more trust and others require less. And so, you know, there may be applications where that will work, you know, and at the moment, if you look at financial services, you know, at the moment, it's almost all applications. It's like almost all applications work centralized, you know, and so the number of applications that won't work are a little limited, you know, and I think, to me, the problem is not about applications. The problem is more of a systemic problem, right? Which is that, you know, it's not that, you know, the economy can't, it's not that the economy has to run on top of Bitcoin. It's rather that if the economy doesn't have a viable decentralized alternative, we'll just do Lehman over and over again. You know, and when I say Lehman, I'm not talking about the failure of one bank, right? Like that's $600 billion of balance sheet. Like it's not that bad, you know. Like if you look at you know, coin check, it's like $500 million. If you look at Lehman, it's $600 billion, right? It's a lot worse. But the point being that, like, Lehman, the failure of Lehman was not the failure of Lehman. The failure of Lehman was the domino failure of the entire global banking system that was prevented by fake money, right? That, you know, the United States government backstopped everyone with quantitative easing, and it's just not, it's not real. Like what happened was imaginary money was invented to prevent the collapse of the whole world economically. So to me, you know, it isn't about it's about, we need an alternative, or we're just going to do that over and over again, and that's not a good idea.
And speaking of alternatives and banks, I know that you advise the Celsius network, which Alex Mashinsky, with whom I've had an interview last week, he says that it's not a bank, even though it has the exact same features that a bank has. And what do you think about Celsius? Do you think it's a healthy alternative?
Again, I'm very much, I would call myself an experimentalist. And so, when I look at a Celsius, like clearly one of the dimensions of Celsius is the idea of trusting, Celsius and trusting the brand, and so in a sense, there's a centralization aspect to what Celsius is doing, right? Which is, they're doing lending. And so you're gaining interest, right? Whenever you're gaining interest, you're doing something related to custody, right? Which is, in order to get interest, you actually have to give someone control over your asset. Otherwise, they can't earn the interest that they're paying you, right? So the bottom line being that, um, you know, yes, there's bank-like aspects there, but what I would say is the following, right? Which is, at the moment, we're accepting centralized financial institutions that are largely unregulated to take custody of our cryptographic assets for which we receive no interest. So, those are obviously the exchanges. So the point being that, um, having an experiment where we see if people, if we can have an institution that provides interest payments for cryptographic holders, it becomes a really interesting experiment because, if you look at something like Coinbase has custody of your assets and gives you no interest. So the question about something like a Celsius would be, what if there was an institute that did the exact same thing, maintain control over your asset or custody over the asset, but then did give you interest? So if you do that thought experiment, it would seem logical that customers of things like Coinbase should eventually migrate to services like Celsius, assuming that the trust can be equal, right? So if all things were equal, which they may not be, but if all things were equal, people would rather get interest than not get interest. So I think that's the mindset behind a service like that.
Yeah, and I've spoken to people about Celsius, and at some point I told them, if you deposit your Bitcoin, they promise they're going to give you like 5% interest a year. And when they heard about interest and they heard about 5% guarantee, they just associated the thought with BitConnect, which promised to give returns based on your deposits. So in a sense, they were also custodians. And the question that comes into mind is, how do you distinguish, where do you draw the line between a clear Ponzi and something which is legit?
Well, the issue becomes, trust issue, and the trust has to come from multiple sources. One of them has to be, maybe a degree of transparency about what they're doing with the money. Another one kind of has to be looking at, past performance. So if you look at, what the people have done in the past, that obviously their past performance is no guarantee of future result. So I think those are important clues. I do think that the sales methodology matters. So I think, for example, if you have some kind of like multi-level marketing, like I think that's obviously not going. And I think from my mindset perspective, you know, it's I think transparency ultimately will probably be the solution for the space in the long term. I don't, in the short term, I don't really know the correct answer, but I do think that um, one of the problems with the custodial solution is it's hard to maintain 100% transparency. So, maybe there's a non-custodial peer-to-peer lending solution that will arise. Interesting. I know Kiva has been successful with peer-to-peer lending, and I don't think they're charging or providing interest. I think they may be charging interest but not giving the payments to the lender. It's all charitable, but I think that we will have new models arising in this space.
Okay, I know that the alternative is Nexo, which is advertised on CoinMarketCap. If you check any coin, you have a button to get a loan, and you get a promotion for Nexo. And when I mentioned Nexo to Alex Mashinsky, he was like, "Oh, they're not even compliant. They are backed by big money, but at the same time, they don't know what they're doing." And I guess that just trash talking the competition in a sense. But do you know about anything that Nexo does differently?
I don't really know much about Nexo, unfortunately, so I would have to defer to Alex. But you know, I do think that you know there are going to be a lot of experiments in lending and in interest payment. And I feel like you know it's going to be interesting to watch the decentralized financial system essentially growing all of the capabilities that exist in the centralized financial system. And you know the thing that's fascinating is that if you look at the replication of all the capabilities and services of centralized finance in decentralized finance, you know the thing that people miss is kind of following the money and knowing where your keys are. You know, the reason why I kind of harp on that is if you buy a house, the first thing you ask is, you know, where are the keys? You know, and if you buy a car, then the first thing you ask are, where are the keys? You know, clever people may ask things like, does anyone else have a copy of these keys? You know, but like they're all asking the correct questions. Those are the correct questions that have to do with ownership, right? Like it's like, oh, you own this. Okay, great. I need the keys, right? So, you know, people aren't doing that yet with their money. And the reason why I think that's an important distinction is that if you don't pay attention at all to that, then you can pretty much have any kind of magic service you want because it's all being done with mirrors, right? You know, so the thing that's funny is that, you know, not to be kind of a crypto anarchist or an extremist, but like, you know, when there is a run on a bank like Lehman, the thing that's amazing, assets aren't there, right? So then the question has to be, and this is going to sound super anarchistic, so I apologize in advance, but like, you know, what's to distinguish Lehman from BitConnect? I mean, you know,
No,
I
right.
realize that's a fairly extreme statement, but what I'm really poking at here as kind of a way of thinking is that, you know, as soon as you cross the boundary into a custodial space, you're back into the centralized model. And the centralized model is, again, kind of dependent on leverage. And the question becomes how much leverage? And it turns out in the case of Lehman, the leverage was extraordinary, right? They were doing credit default swapping on top of mortgage. So it's mortgage backed assets. But the problem is that at the end of the tail, the mortgages weren't even good, right? There were robocalls unqualified people to buy mortgages that they couldn't afford and couldn't pay. And so even the ground we were standing on, the so-called real estate we were standing on, was like hollow. You know, so not only did we fall from like an airplane, but when we hit the ground, we kept falling, you know, because the ground was like completely hollow. Because everyone thought we were standing on real estate, which is like ultra solid and reliable. And even that was a fake. So like, you know, it was, leverage was extreme, you know. And so I do think those need to legitimately be concerned about, right? Which is, you know, once the model becomes custodial, the question about the asset itself becomes, you know, the leverage is the scariest thing.
Hmm. So I guess I should allow you to speak a little bit about yourself and the latest projects that you get involved in. And if you have anything to promote or to hype at this point, this is your chance to do it.
That's very kind. I appreciate that a lot. You know, we have talked about some of the bigger projects that I'm affiliated with. If you're interested to kind of understand the things I am involved in, you know, just go to miko.com, Miko.com. You know, I'm not one to kind of directly pitch or hype, you know, things that I am working on. To me, you know, it's better for people to come to their own conclusions. Obviously, this space is riddled with lots of people hyping things, and you know, I definitely don't want to be in the chorus of kind of hype artists. You know, from my perspective, people should do their own homework, and they should figure out, you know, how they can benefit or how they can contribute, and I feel like that's my mindset.
Okay, so I guess you don't really like people like John McAfee.
Well, I've met John, and I can't say that I dislike him as a human being, but I do question some of his tattoo making, or this type of activity, because it's not clear to me that that serves the economic benefit or well-being of the industry. So it's not entirely clear that creating leverage like that in social media is actually going to produce the kind of financial infrastructure that we all desire. So that's the way I would say the way I would say it.
But do you believe in his price prediction?
Uh, I tend to also be more conservative about price prediction, which is, it's my sincere belief that these systems are much more nonlinear than you could, than anyone can say. Like, here's an example of one lever, right? Is, like Heather Crypto Mom from the SEC, one of the SEC commissioners, has, herself said, hey, I can't tell you if Bitcoin ETF will be days or if it will be years, right? And as a good commissioner and as a good politician, she's not someone who will ever give any hint about when something like that would happen. But if there was an approved Bitcoin ETF, it could drive institutional adoption, as a signal to the market, right? And the thing that's funny is the signal could be self-fulfilling, which is, people have talked about it enough that, it would be like the Coinbase effect, or buying, just basically it would be a major listing and lots of people would buy it speculatively, thinking other people would buy it speculatively. So my point is this, is I don't think anybody knows the time. I think there may be SEC commissioners in their heads that may have an idea of what the timing is, but there's no way any of them are going to say a word to anyone else, because that would be insider trading in the biggest possible way, in the darkest possible way. So I guess what I'm trying to say is, we're just looking at Bitcoin ETF and how opaque the timing is. And that's just one dimensional variable across like thousands of dimensional variables. And so, I'm definitely not a bold predictor of prices and timings. For me, I'm more of an investor than a speculator. And so my perspective is more, am I long on this technology? And I would say I certainly am. When is the market bottom? I would say the bottom isn't in yet. I think that in my view, the bottom should mirror the top. At the top of a market, you see ridiculous waste of resources. So for example, you see like people buying Lamborghinis and things, partying on a boat, kind of stuff. So you just see waste of resources, right? At the bottom of the market, you also see ridiculous waste of resources. And the wastes that you see at the bottom of the market are, you see really, really hardworking technologists with real products that are going out of business, and we've seen some of it, but I don't think we've seen a proportional amount of that kind of carnage. I don't relish it. I don't like it. I think, waste at the top is bad. Waste at the bottom is bad. I feel like we should try to create a stable, industry that enables, really, really solid products to ship and deliver value, and screens out people who have nothing, and I think, the industry is starting to self-regulate. And I think the fact that, ICO bottomed out, is in the sense that, who's investing now are basically professional investors with dry powder and diligence. And, it's almost back to the VC model, and the VC model is imperfect and there's lots of badness to it, but like, good companies have come out of it. So, I think that we'll hopefully see good companies come out of this as well.
Okay, Mr. Matsumura, it was a pleasure to talk to you. I guess this interview was so much more than I expected, because at first I've done some research in regards to your projects, and it wasn't I who set up this, and I just had to do it. I'm just, you know, the diplomat, the intermediary, the third party. And what I got was surprising. It was like an insight on what happened with the banking system 10 years later, and how we can actually use this new technology to make the world a better place, even though that's a big statement, and that you hear that a lot from a lot of tech companies. But really, thank you. And I hope that we will be speaking and maybe talking about new projects in the future.
Absolutely. I enjoyed this a lot. Thanks for your inquiries, and definitely appreciate what you're doing.
Yeah. So this will be published next week, I think.
Great. Thanks a lot.
Okay. Bye.
Bye.